morning and welcome to the 113th episode of the Veritas fact-finding series. And this morning, I'm joined by Jeremiah Shamess. Good morning, Jeremiah.
Good morning, Anthony.
In each episode of the Veritas fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors, and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like, follow us, and visit for more details at www.veritascorp.com. By way of background, my name is Anthony Scilipoti, and I'm the president and founder of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say this year we just celebrated 23 years, 100% employee-owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants and or employees of the Veritas group of companies may own securities discussed in this broadcast. And while we love all our guests, and Jeremiah, of course, in particular, this session may contain forward-looking statements, investment opinions, and comments, which we may or may not agree with at all. Now, quick note on Jeremiah. He's been at this business of real estate now. How many years is it, Jeremiah, that you've been at this?
13 years.
Okay. But most importantly, he joined Colliers and founded and leads a group called the Private Capital Group. And it's a group of 6 professionals that works on building and land sales, land aggregation, consulting, and working with both sides of the table, not just owners, but also purchasers and investors. He was number 1 in downtown office here in the GTA in 2021 and top 20 in the country. He was a top 10 producer in Toronto downtown office, both in 2019 and in 2020. And he's looked at for his experience and his ability to get deals done. Jeremiah, thanks for your time and joining us this morning. I want to start off, as I do with all our guests, just give us a quick update on yourself. Tell us about yourself. Tell us about your current role, how you got there, and why it is you do what you do.
Yeah, thank you, Anthony. So I always joke that we didn't when we first started out with Colliers, it was not a public company. It was a little more of a cowboy shop, I'd say. So, I started out as a research analyst in the West office, and I circulated through all the different asset classes. And then at that point, I joined a team and I started working on development land sales and then eventually investment sales. And then from there, I went out on my own. And then eventually what I realized is there is a large hole in the market for private owner representation, a private client, effectively sub-institutional type asset classes. And I started concentrating on that asset pool in Toronto area, the boroughs, as well as the GTA and downtown Hamilton. And, I started to get some success in that space. So I founded the group, Private Capital Group, with the late Jeff Arnold, who's not with us anymore, but he came up with the name and he said, you're dealing with all these types of owners. So we've actually grown the group significantly. We're formalizing the team across Canada, but more specifically, we've been working with Montreal and Toronto to service owners of real estate and represent them exclusively in the sale of building and land.
And why real estate? How did you decide that that's where you wanted to focus your career?
That's a great question. My whole family was doctors, and
see, this is important.
Yeah. And I still remember I went to Western, and I was on the rowing team. I'm sitting there at like 8 a.m. after going to class in a physiology class thinking I don't know if I can sit here and talk about cell structures for the next 6 years. So then I started doing the Ivy classes and started doing business courses, and I finished a science and business degree, but I was actually quite interested in the business side of things, more realistic in terms of getting things in the real world done. Not that, medicine is not important, but my whole family was there. And then after that, an older cousin, he ran Magic Johnson's real estate debt and equity arm in the US.
Wow.
And yeah, he introduced me to commercial real estate. And from there, I met an alumni who's now vice chairman at Colliers, who kind of took me under his wing. And that's really, I guess, the rest is history, as they say. But, you know, really, I like the fact that real estate in Canada is still relatively new as far as our structures, our city, all the development. You know, Toronto is really only built out to metropolis in the last 20 years, right? We still have a lot to go. So I started out in the development land. That's what I'm known for. I sell a lot of office buildings, retail plazas, apartment buildings too, of course. But you know, the majority of the work has been development land in the Toronto area, which is what we're known for.
Great. Okay, Jeremiah, let's dig right in. Let's start with a very, 20,000-foot question, and then we're going to unpack each of the different components of commercial real estate. We'll start with the hot button, which I think is office. We'll then move to industrial, then multi-res, and lastly, retail. If you had to put your finger on the pulse of what it's like overall in commercial real estate, give us a measure.
Well, it's a good question. Like I like to look at the dollar volume amount of transactions that have happened and the number of transactions. Those kind of give us a really good temperature gauge on where we are. And if you look at those numbers, we're about roughly now 14 months into a correction. And when I say correction, I define it as a 20% decrease in dollar volume amount from the year before. So, you know, it's interesting to see that Toronto has been pretty, significant in terms of number of transactions for the past really, like, call it 10 years. And that dollar volume amount has been pretty consistent. It's been ratcheting upwards. Of course, in 2009, there's some significant issues there, but going back that 10 years to 2014 has been very consistent. If you go back a further 10 years, minus 2008, 2009, 2010, it was still pretty consistent too. But ultimately, when you look at the temperature gauge of what's going on today, we are in a correction in the commercial real estate market. I think we're roughly, probably going to be in this for, quite some time. But when you look back to when the correction started, it was roughly September of 2022. And that's when the volume started to drop in all the asset classes. You take multifamily, for instance, apartment buildings. In Q4 of 2022, the transaction dollar amount dropped some 90% from the year before. So, you really started to have some very significant drops in transaction volumes, number of transactions done, and that's continued to amplify throughout this year. So when people ask how it is, it's not great. But with that said, we still have a significant amount of liquidity in the market. It's not the end of the world, because when you look at, the 10-year moving average for number of transactions actually done, there's still a good $2 to $4 billion, depending on which asset class you're talking about, that happens to sell every year. So 2021, 2022, those were very highlighted years. They were kind of abnormal. You had,
in terms of, because volumes were so low.
So high.
So high.
21, yeah. So 2022, it wasn't until the last quarter that your transaction volumes dropped off. So, you had effectively in, I'm just going to pull up the number here, in 2021 rather, you had $32 billion of transactions in the GTA, like massive amount of transactions. That dropped down roughly 4 billion in 2022. And now we're on track to be about 60% of that in 2023.
Wow. So just over 2 billion.
Yeah. So it's, we've changed significantly where the transaction volumes have, but like, you know, there's still a ton of liquidity. People forget.
So very similar. I want to dig in then. It's very similar to what we're seeing on the residential, and I don't want to talk about it here, but we just finished our real estate conference, and volumes are way down, and we're in a situation on the residential side where buyers don't want to buy because they don't believe the price, and sellers don't want to sell because, of course, the same reason they don't believe the price. But I think you said dollar volumes, but dollar volumes is price times quantity. So what's happening is the overall transaction volumes decline, but price is not off that much. Is that fair to say?
No, price is off about 20 to 40%, depending on asset class.
Okay, so let's dig into each asset class. Let's start with office. Talk to us about what's happening. We can start with the take that says, the city of Toronto, they just did a study to reconvert office space to residential. Calgary did a study. They just suggested that us giving a $75 per square foot incentive. What do you think is happening here? Where are we going?
Well, we had a weird year for office because there was a number of very large transactions, but it was because some of the institutional groups had to get some of these, excuse me, some of these assets off their books, right? They were heavily weighted to office. There's been a paradigm shift in terms of the use of office. So we see a lot of landlords looking to trim up some of their assets in both the, more so the B class and C class office where they have higher vacancy. They're looking to actually sell this while there still is some vacancy, or while there still is liquidity. So, in the third quarter of last year, we had 1.7 billion in office sold, 500 million in office sold. But this year we had 1.7 billion in office sold. So that's kind of like a little bit of a blip, but overall, you still have transactions are trending in the number of transactions. They're actually trending higher because smaller deals are still happening. We recently just sold a few office buildings downtown Toronto, and these are buildings that are sub 30,000 square feet. Mm-hmm. So that type of transaction volume is still happening. There's still users out there, there's still buyers of this type of real estate. But like you said, because you have cap rates that have significantly increased, when you look at the basis over, or rather the basis over that bond rate, which they're actually borrowing at, it's actually not in proportion to the amount of interest rate increases that have happened. So there are still some buyers who believe in the market and it will come back, but that's becoming few and fewer. So you have, like, the best way to describe it is, you have this kind of, I guess, balancing act between fear and greed. And those are the capital sources that have been leading to the amount of transactions happening. And greed was winning over many, many years, as you know, being in the equity side of the business. And now it's diminished, and you have more and more buyers starting to be fearful. The optimists are turning to the pessimists. And so that slowly drives transaction volume down. That slowly brings less bids in for each asset, and that brings the pricing down because then the sellers have to chase the value of that price diminishing every year. So when you look at actually what's happening on a stats basis this year, we're actually very similar to last year on office. But if you compare it to what happened in, say, 2017, we're actually down quite a bit more. And if you look at 2019, there's even more significant drop. So office
drop in number of in dollar volumes, is that what you're always measuring?
Yeah, dollar volume.
Yeah. Okay, keep on.
Number of transactions is really more related to, how big the transactions are. Are they smaller deals happening or larger deals happening? And 2019 was really one of the last best years for office building sales. And then you had the pandemic, which has changed that paradigm. So, on the equity side of the business, there are a number of REITs I think are going through significant issues right now. Not only that I think their market cap trading is even below where the debt levels are they have. So there's some serious issues. And because of that, you have a lot of institutions who are heavily weighted in office who are trying to drop some of those buildings. So that's why the transaction volumes are actually pretty similar to last year for office, but it's because they were already decreased from 2020 when they took this massive hit from 2019.
But we aren't seeing, so, you know, this you would think would translate into the leasing side, because if they're seeing that their cost of capital goes up, they need to deal, and obviously leases come up for renewal. We're not seeing them give deals, or are we? What are we seeing on the ground on the leasing side?
Well, it's nuanced, Anthony. So like right behind me, you can actually quite see, like you can't quite see it, but they have, so Heinz's building right behind me, the brand new CIBC Square. They're building the second phase to it. So the first phase was already completed. Heinz finished that off. That's like kind of a sign of the times, I would say. It's the largest office development site that's been done in Toronto since my office building I'm sitting in Brookfield Place. And so that is kind of a direction on where you see these types of AAA asset classes. The rates are not coming off. In fact, they're very sticky. So, you know, you take, for instance, an office building like that, where, you know, rates are, you know, in the range of $80 to $90 gross. And then you look at something like a B class or a C class office, something that's not connected to the path. You know, it's maybe closer to Jarvis and King a little bit. I like to call maybe first tier suburban outside of the downtown core. Those office buildings are taking significant decrease in their rates and the demand for that type of office. So they're having to find their bottom lower. Whereas the AAA office, the brand new office, people still want to be in that. So there's a flight to quality that's happening. And what's even more interesting is that you have, even within the AAA office, you have some trading where people are looking to get into the newer buildings because they have a higher amenity space, you know, which, because they're trying to bring their employees back to the office.
Yeah.
They want their employees to be happy and, you know, using the different amenity space within the offices. So they're saying we need to get into an office building that actually has this type of amenities, so we're not actually trying to beg them to come back, right? So we're hearing a lot of that. And so to answer your question, it's very nuanced. And the B and C office and first tier suburban locations is taking significant hit. Suburban office, low rise, walk up type office and office parks near office buildings are still doing quite well because they're more service-based office users. They're small leases, sub 5,000 square foot. That use is still doing well, you know, relatively speaking. But when you look at our vacancy, AAA office is vacancy is around, I believe it's 9%, roughly 8 to 9%, depending on which data source you use.
Yeah.
And when you look at the entire vacancy of the market in the BC, you're closer to 15%.
Right.
So, you know, when you think about 7% being in equilibrium, you know, that 9% trending for AAA office is pretty close.
But where do you see it going? So here we are. You said we're not over in the correction. So far, the AAA buildings, they've held up. I'm sitting in one of the Cadillac buildings myself right here, and I can attest to that. But there, you know, I can still roll a bowling ball down in the underground on Mondays, Fridays, some Tuesdays, and I might not hit anybody. And so how's that going to reconcile when, from what I understand, on renewal, renewal sizes are coming down anywhere between 10 and 15% in terms of the square footage that tenants are requesting. So how does that keep rates high?
Great question. I think that there is a stickiness in kind of the ability to actually lease space is not really going to change that significant. No one's going to build new office space now. So your AAA office, there's really only, I believe, 11 or 12 buildings in the core that actually have that availability of space. So when you add up that square footage, it's really not going to have a, you know, certain dramatic effect to the market on the absorption side as you would see with the B and C type office, because we have in the GTA, there's roughly, I believe, close to 75 million square feet of office now. Yeah. And most of that office is made up of business parks, suburban office areas like Markham, Vaughan, Burlington, even some stuff in Oakville. Like it's going to be very difficult for landlords to deal in areas that are off campus locations without certainty on amenities that will be built or existing. Those are the types of locations where you're going to see very tricky landlords who are having to drop their rates or having to look at new type uses for those spaces.
You mentioned that there were some landlords that you were more concerned about. Can you share any? Or
I can't share any because okay, they're all our clients. But I mean,
that's okay.
They all know exactly. They all know what's going on, and this is there's lots of it's public info. I mean, you have the market is looking at office REITs as a very negative indicator of where the market will going. So, or is going rather. So, and to give you some data points, talking to some of my colleagues in say San Francisco, you have a lot of beautiful, awesome, brand new builds and some completely renovated builds and significant type spaces in downtown San Francisco and LA that are trading at roughly, I believe, 60% of even like 2014 values, 2015 values. So you have office buildings in downtown San Francisco trading at like $200 a square foot. In LA, you have office buildings trading at like $100 a square foot. In New York, you have some of the same down at 500 a foot. Like, so, and these metrics may not mean a lot, but they're effectively down 60 to 70 to 80% off. The only office markets that are good right now are like Miami, West Palm Beach, and certain parts of Dallas and Austin.
And from what you're saying, probably Toronto, because we're not seeing any transactions. We're not seeing any transactions take place. No. So then it comes
just to add one point. Vancouver is the single greatest office market in Canada right now. It has not moved because there's no product in Vancouver. So there are very little new office buildings have been built there. So there are still very significant trades that are happening there. The rates and the cap rates are still decreasing, but Toronto being a large office market is the bigger issues. Montreal has significant issues. Rates have not moved in 40 years. And Calgary, Slate Office REIT just gave back a few buildings to lenders. So Calgary is going through some significant changes as well.
You just touched on something that I had on my list I wanted to ask about. Landlord says, you know what? It's not working out. Here are the keys. There's non-recourse. Walk us through real life. What happens? Because that's the case, right? For a number of these property owners that claim that they don't have any recourse. But on the ground, what really happens?
I mean, it's a good question. So I was actually dealing with that this morning.
Good.
A significant client who's going through a receivership right now. And the receiverships and not CCAA tends to be, pretty standard proceeding for, call it, handing the keys back, or more so the lender grabbing the keys. But like, we have not seen a significant amount of receiverships and bankruptcies, power of sales in the space yet, except for development land. There's been a lot of development land. There's been some industrial buildings that have gone because buyers have, let's call it, stretched when industrial was going through this massive increase in appreciation, that started in 2018. Rates basically were doubling every year. The value of buildings was over the value of office buildings on a price per square foot basis. So that market went a little crazy. You had some people stretch a little bit. Those guys are handing the keys back on industrial. On development land, because it is a non-income producing asset, you really have to get it into production to actually deal with your cash flow, your revenue. So anyone who's dealing with development land has a burn. Like it's almost like you're starting a startup, a tech startup, and that tech startup has a 18-month burn, and then things run out. If you don't get it approved and get it to construction and sell your condos or get your revenue, then it's game over. So a lot of the development land is the first number of receivers that are coming through. And the office buildings, there are a number of those that are happening as well. To speak specifically about what happens when that, proceeding actually happens, like effectively the lender gives notice, they go to the court appoints what's called a court appointed receiver. That receiver is effectively, like, they're typically accountants, KPMG, Ernst & Young, KSV. These types of groups are very good at what they do. They go through the receivership where they then hire out broker specialists to go out and then sell this product. You have to go out and do a process that is as let's call it as broad-based as possible to ensure that you can prove to the court you were getting market pricing, and then you effectively go out and look for a buyer who is going to be the most security in actually closing. So it's a true testament to kind of market pricing. We've seen a number of those where there's been decreases. Myself, I've done a few of the State View receiverships you've seen probably in the news. And we have a few others that we're going through right now that I can't name, but these sorts of proceedings are starting to be a lot more common, and you're starting to see a lot more of the lenders who are actually losing money. Their mark to market is actually becoming real. So,
and as this piles up, because you started off by saying you don't think it's over, this correction or these challenging times we're facing. But tied to that, there's a number of these mortgages or these loans that are non-recourse. And so all through that process you just walked us through, then the last part, you hand in the keys. If there is a shortfall, a mark, and there is recourse, then the lender goes after the owner, right? Or the equity holders. In the event that there's non-recourse, there is no, the owner just basically walks away. But what happens?
There isn't recourse.
Pardon me?
Most of the time there isn't recourse, like in a lot of these. It's only the construction loans, the massive construction loans, where you tend to see a lot of recourse type deals where they'll actually try and go after it.
Yeah. And so there's no impact on the borrower later. Hey, I want to borrow some more money because I have this other product that I'm running, or I have this other development that I'm doing. Does that factor into causing an issue?
I mean, we're getting into a very nuanced discussion, and I'm not a lawyer and accountant, so I know that there are situations where a lot of these borrowers have sitting on recourse loans, so they will have to, pay back these loans if the lenders lose money. And a lot of these groups will cease to exist, I think, quite frankly, and sadly. But at this point, I know that a lot of the lenders are having to effectively take some of these losses on their hands themselves. And I would say the majority of the work we're seeing happen right now has been non-bank lenders. So you're not seeing a ton of receiverships in power of sales from the big five banks or any of the credit unions yet. I suspect they will happen. There has been a few that have happened, but more so we're seeing those groups are actually able to get some of their capital out, because the banks and the pension funds, the life goes, they're typically, at 50% value in the capital stack. So they're typically able to get some of that money back. Those are I haven't seen anything where it's like 60, 70, 80% off value yet.
Got it. And I just want to remind all our viewers and listeners, if they have a question, to just scroll down to the Q&A, type it in, and I will make sure make sure that Jeremiah addresses the question. Jeremiah, just before we leave office, I started with a point about conversion, and any thoughts on that, office being converted to multi-res?
Yeah, Anthony, it's a great question. we get asked this all the time. We actually have an in-house development team that has been analyzing this. And I've actually personally been in contact with a specialist out of New York City, where the majority of the office to residential conversions to happen. The Coles Notes is very hard to do. And in order to do it, you have to have a cost basis on an office building that is probably sub $150 a square foot. Now, I'm speaking pretty generally. We've run some analysis on buildings in Calgary and in Toronto.
Yep.
And the most of the time, the cost base is too high to make sense of a conversion. And then there are a number of physical constraints that actually can lead into how you would actually convert this building to. So I'll give you an example. I'm in Brookfield Place. The office floor plate here is roughly 20,000 square feet. If you would try to convert this to a residential building, you would have probably close to 40-60% of the space unusable in residential, unless you had these massive long bowling owl type like units. Like, so it doesn't make a lot of sense to convert most of the office buildings unless they're the smaller floor plates. Like, to give a little bit of a comparison, the city of Toronto requires that point towers have a guidelines, they call it the high-rise building guidelines, where they have a floor plate of roughly about 8,000 square feet. And most office buildings have at least 10,000 to 15,000 square feet is probably the minimum you'll see in the average office building floor plate. So the efficiency of actually converting it is very difficult. So I think you'll see out of 100 office buildings, the ability to convert those buildings, you'll probably only see maybe 10%, 5-10%. We've met with a few architects or specialists around the world, and it's not an easy conversion. So this big savior to the residential, housing crisis by converting unused office spaces to residential, I think that's incorrect. I think it's a little bit of a fallacy when people actually start to dig into it. But that's not to say there aren't a number of office buildings that will. And if you remember, I was talking about the biggest issues in office right now are in the B and C class type office buildings. Those B and C type office buildings, they typically have smaller floor plates because they were built, say back before the 80s, 50s, 60s, 70s, 80s. So when you're dealing with, a client of mine just bought an office building downtown Toronto. It was a smaller office building. It's got 6,000 square foot floor plates. Perfect conversion potential in that building. Now, he actually has it 90% leased, so he's not going to convert it, which is fortunate for him. But in some of the buildings where you do have those smaller floor plates, you will see some conversions happen, but it's not a savior for the market.
Okay, let's quickly, in the interest of time, and I want to make sure that we unpack each of the different other classes. Let's just quickly, that you touched on industrial. We've seen a huge boom through largely, during the pandemic, and even starting before that. You said from about 2018, industrial really took off. Now it's kind of where is it at, and where do you think it's going?
Well, Anthony, we're 13% off of last year, and we're 92% up from 2017. So that kind of gives you an understanding of like the market's doing okay. Now, what has changed dramatically is land sales. Industrial land sales effectively dropped off a cliff. That's accounting for your dollar volume decrease. Most of the other transactions have still been buildings. There still is a almost insatiable demand for industrial, but anecdotally, I can tell you right now, my colleagues are telling me, who are specifically in the industrial leasing space, are telling me that demand is dropping significantly. So they are seeing on the ground changes in the industrial market for demand, which might be a pre-indicator to a recessionary type forces coming in, but is the strongest of all the asset classes at this point still. But that change is happening pretty dramatically. And I think that, like, when you look at our 10-year moving average in Toronto, for example, which is the strongest industrial market in Canada, you still have $6.5 billion of industrial stuff trading this year. It's still quite significant. And traditionally, Toronto, the highest dollar volume amount for asset classes has been residential land. Right now, it's now industrial. It's converting to industrial land. So we have a large stock of industrial. We're the fourth largest market in North America. And the way that the Globe looks at Toronto, they look at our rents and they say your rents are still 50% of, say, the top line rents in like a New Jersey industrial building, for example. So we are still viewed as a still, call it a significant logistics hub, connected to the Great Lakes, connected to major metropolis, connected to a major airport and rail distribution network. So there's a lot of strength in industrial. I believe that will probably continue, but we will see a decrease off of highs from our kind of, our ZERP, 0% lending environment.
Understood. All right, couple more. Why don't we just talk about multi-res?
Multi-res, that is a tricky one. So this year we're about 50% off of last year as far as our dollar volume amount, even if you annualize things. And as
prices how have prices moved?
About 20 to 40%, depending on the asset class, which is really the cause for the decrease in transaction volumes. So like, people don't want to sell because they are used to getting prices that are anywhere from 20 to 40% higher.
Yeah.
So, but like, there's still really good demand for it. So we just sold an office building in a really good area.
Sorry, you mean a multi-res?
Or a multifamily building, apartment building in a good area in Mississauga. And, we still had 10 offers. So there's still, significant amount of liquidity. There's still a lot of buyers out there. But that's when we price it correctly. This office building was priced at market. We effectively said, bring us your best offer. The seller will sell at market value once it's, been proven through multiple bids. And so we still had 10 offers. And there were still a lot of buyers who I would say are optimistic about the market. Is that pricing down from the highs of 2021, 2022, the first half of 2022? Yes. It is, because the bond market has changed substantially. CMHC lending, which is the lowest cost provider of debt for multifamily in the market, they have been backed up. They just increased a tranche of 20 billion in order to get more funding into the market, which was positive for the market, but it's still very hard to find that. So multifamily, we're dealing with sellers and buyers who are not coming together and who have a differentiating view of where the pricing of these assets are. And I always say that apartments are the most sensitive to interest rate environment, because that sensitivity is very carefully linked to the spread between our bond market and the actual lending rates, because that spread is the lowest of most of the asset classes in the market here. And that's really just because almost every single apartment building that's sold, that's not brand new and hasn't been stabilized, has this inputted value in the building that cannot be directly attained on day one, because we have rent control. So in Ontario, Alberta being the exception, Vancouver the same, but BC the same, because you have a building that trades and most of the rents are like, 60 to 80% off of where they should be, but they're actually not. You're only going to have 5 to 15% turnover per year in these apartment buildings every year. You can't actually attain that value. So that's why they trade so close to that spread, because people are willing to take a more aggressive risk on the actually inputted income, because the income could be 50, 60, 70, 80% higher. It'll just take time to get there. So, the point is that the apartment building sales, they don't look healthy when you look at the numbers. 48% from last year. We're only at 1.5 billion this year. That's a significant drop. But when you actually talk to the owners of apartment buildings, they still have very good demand for rents. Rents increased dramatically since 2020. They are leveling off now. We are starting to see some anecdotal evidence of what we would call the step down renter. The renters used to be, I'm renting a 1-bedroom. I want to get a 2-bedroom. I want to get a more luxurious. I'm going to step up. You're seeing the opposite effect happen now, which is something to watch very closely for apartment building owners, because that may hit the top end. And I think more of the luxury units, those are going to get hit a lot more significant than, say, the B class, C class, where it's the opposite of office, right? People are going to say, I don't need to be in a building that is the best of the best class. I'm going to save $1,000 a month. I'm going to move to a building where I have a little bit of better cost base. So we're seeing the opposite of office.
Very interesting. And last, but definitely not least, retail.
Yeah, so retail's a funny one. It's you have this insatiable demand almost for neighborhood-based strip malls and these smaller service-based retail buildings. Like,
wow,
I'm telling you, it's incredible. We sold one north of the city. We had 100 NDAs signed for interest on this building. Like, it's incredible. So what we're seeing in the market is sub $25 million trades for retail neighborhood focused strip malls, something on a corner that's serviced by tenants that are very like kind of service oriented. You have a small little market. You have a dentist. You have a nail salon. Of a little restaurant,
barber.
The barber. You got the guy who sells kebabs, a pizza shop. Like, these are not going anywhere. In fact, they're doing better because people are coming for low cost, value-based services, right? So we saw in the middle of the pandemic, people, effectively had a freak out about retail because they're like, retail is going to blow up. It's not going to die. Since that time, everything stabilized and people have realized service-based retail is not going anywhere. And these neighborhood-based strip malls are very interesting to most investors because they also typically sit on at least 1 acre of land, and that land is functional, for the future, in which we still have a housing deficit in Toronto. So retail is very nuanced. Grocery anchored retail, neighborhood strip malls retail is doing extremely well. Street front retail is probably been hit the most. That I would call basically in the single worst asset segment in retail. Obviously, large box retail is having some issues as well. But overall retail, we're down 32% from last year on our dollar volume amount. It's not that bad given the fact that, you already had retail going through some changes after 2020.
But if you had to parse that to the local strip mall sitting on an acre to the, big box and as a different class, and then there's the other class, which is the classic mall. How does it break up for each of the three? And because it's, A class, B class, the difference, what's happening on each of those?
Yeah, it's a good question. Yeah, strip malls and big box retail are down roughly 40%. I don't have the exact number, but I know that strip malls and neighborhood retail is up 16% dollar volume amount year over year. So that continues to be a very attractive asset class. There hasn't been a lot of enclosed mall transactions. The ones that are happening, you could give one example. There was a pension fund that sold one, and they actually sold it for less than they purchased for it about 15 years ago. And then you have another one that was sold, again, less than purchased for, but it was bought by a residential developer who's actually going through a nuanced play where they're going to cut up the mall in half, build on most of the land, and actually deal with more of that. That was Center Court in Pickering, because they actually launched 2 of their residential towers already. They sold those towers out in Pickering. So that mall, Pickering Town Center, used to be, this massive old school mall you saw before, but it's been cut up. So those are examples of enclosed malls. And then you have, the grocery anchored retail, which is still very attractive, but you've had call it mark to market off of highs of say 4.5% cap rates, into the 5 and 6s in certain areas, and 7s in, tertiary markets. And so you're seeing, again, a price drop on all this stuff, but you are still seeing significant demand for the right type of uses.
All right. Again, just to remind everybody, if they have a question for Shamess, to please type it into the Q&A. I'm just launching our poll so everybody can tell us what a great job you've done, Jeremiah.
And if you want, we didn't touch on this, but if you want, I can touch on residential land, which is a significant asset class in Toronto. Can also touch on hotel sales, but we have an excellent hotel group, which I do not trade that. Alan Pirani runs it. But just to briefly touch on residential land sales. Residential land sales has been the stickiest, biggest asset class in Toronto because we are a city that is building. Traditionally, we've sold about $4.5 to $5 billion of residential land per year in Toronto. This is off about 40% in Montreal. In Vancouver, it's off about 50% just dollar volumes because they're smaller markets. But you have seen in 2017, 2019, 2021, and 2022, significant increases from that dollar volume amount to 2021, which was $8 billion of residential land sales. That's come off 60%. And we are seeing a dramatic decrease in the amount of land sales that's happening in the market. And it's mostly because people don't want to buy something that's not income-based. Right. So we are seeing the same thing with what's happening in office, a flight to quality locations. Location matters more than ever. It didn't used to matter in residential land sales because you could put up a condo almost anywhere and sell the units. Now the affordability factor is causing change there. So that's, in turn, changing the land market. So the funny thing is that you're seeing some of the best locations come on sale. Buyers are still scared to buy it, but the best, deepest pocket buyers are still buying that stuff because they understand these locations are not going away. So that's, just a little bit of a piece of what's going on in residential land, because we still have this massive housing deficit here.
Jeremiah, I have to tell you, we've been going now here over 45 minutes. My head's going to explode, keeping up with all the numbers you have packed in there. I'm very impressed. That's been a wealth of information. We've touched on all the things I think we wanted to touch on, and the fact we don't have any questions means you've exhausted even our listeners. But what I am curious about, you've touched on really 5 different asset classes, sort of. If you had to say, if I was sleeping at night and I was worried, because you said it's not over yet. We're some 14 months since a shock, let's say, started in the market. Which of the classes are you most worried about, and what are you looking for as being, goalposts that you would say, hey, you know what, things are now getting worse, things are now getting better?
That's a good question. I mean, unfortunately, anecdotal evidence is really going to be the biggest one on when the goalposts turn over. But we're going to see the dollar volume amount of transactions actually increase more than 20% from the previous year. That'll be a signal that the market has really started to turn back up, in a sense, and recover. Like, as you can say, like, we haven't had a real downturn in Toronto commercial real estate since the 90s, except for industrial. Industrial went through a significant change in 2008 to 2011. And when you analyze those numbers, you realize that market, it did not come back to where it was and call it, a stabilized market till 2016. So industrial kind of went through this same effect. I think the same thing is going to happen here. We may be in this, call it, corrected market for quite some time, but it doesn't mean that we don't have liquidity. It just means that we're not going back to the heyday of, say, 2019, 2017 for residential land, for apartment buildings, 2021, we're not going back to those highs, but the liquidity is still there. But there's going to be a big refreshing of the market, of pricing, of expectations, of type of locations, of what buyers want, of what lenders are willing to lend at. We're in a paradigm shift here. And this is changing the way that commercial real estate is going to be viewed. And I think it's, not a bad thing, unfortunate for some, but I do think that in the long term, Toronto is a very strong prospect as a city, considering the fact that we are building new infrastructure continuously, and we have still this housing deficit and significant amount of demand for people who want to be in the city and in Canada in general. So I'm still long Canada, but it will take some time for, I think, this to come and work itself out.
We got a question here from Nancy, and so let's deal with this. Do you think the Chinese property market issues will affect our Canadian market in any way?
That's a very good question, Nancy. Like, just to give you some stats, the foreign buyer market for development land and building sales in Toronto is very small. It's 2 to 3%, depending on the year. So commercial real estate in Toronto, not really going to have a major effect. You have one of the largest industrial buyers of real estate as a foreign entity, Prologis. It's bigger in the industrial side, but on all the other asset classes, not that big. When you go to Vancouver, it will have a significant effect. A lot of the money that was coming into Vancouver on both the residential side, the apartment buildings, income producing type stuff, that was foreign entities from China specifically. Will that market change? Yes, drastically, and it already has. So the Vancouver market may start to have a kind of leaning back to the norm. I know, talking to my colleagues out there, that the market really just got out of control at one point. And even if you look at some of the most significant developers in the Vancouver market, some of the groups who have been there for 20, 30, 40 years, they hadn't bought something in 5, 10 years, right? So they started going to the US because they couldn't make sense of it. When those buyers start to go back to Vancouver, you see these significant groups who've been around for 30, 40 years, then you know that the market is kind of settled and that it's come back to a normal set of transactions and equilibrium between the buyer and the seller.
Wow. Yeah, I was just in Vancouver visiting some condo sites. I'll be writing that up over the next few days. Visited the new Curve and so on. I'm going to leave you, as I do all our guests, with two quick questions. First off, your favorite book.
My favorite book?
Yeah.
I'd say I'm reading one right now. It's called Zeckendorf. It's about a fellow named William Zeckendorf, Bill Zeckendorf, who was like the real life monopoly man from New York City from the 40s to the 70s. And it's honestly my favorite book right now because he goes into detail on the emotion of what happened after the crash during the World War II era. He also talked about, he did this massive land assembly where United Nations still have their property today. He talked about what was happening around the North America as it was going through this massive building boom. So it's definitely probably my favorite book that I'm reading right now. Just a little piece for over the long term. My favorite book growing up was Farley Mowat. I read a lot of his Canadian type wilderness books, the authors like Owls in the Family and Lost in the Barrens. Those were my favorite growing up.
Very impressive, Jeremiah. Now, the last question, your favorite breakfast restaurant and your favorite breakfast meal.
Favorite breakfast restaurant and meal. I'd have to say, actually, in Parkdale, there's a place called Easy. It used to be Easy Rider, and that, I think that's my favorite breakfast restaurant. They have these waffles and egg combo with a little like bacon. That's like my Saturday morning right there. So
I love it.
that's
Jeremiah,
my
we're gonna have to come, I'm gonna have to come out and meet you there and take a video. All right. Thanks, everybody. Again, appreciate your time. We'll see you on the next show. Jeremiah, we're gonna check in with you over time to see as this evolves.
Absolutely. Thanks for having me on, Anthony.
Thank you. Well done. Thanks, everyone.